A tax haven is a country or place with very low, effective, rates of taxation for foreign investors. Can feature in some tax haven lists. They are not universally considered as tax havens. In contrast, countries with lower levels of secrecy but also low, effective, rates of taxation appear in most section tax haven lists. The consensus around effective tax rates has led academics to note that the term tax haven and offshore financial center are almost synonymous. Traditional tax havens, like Jersey, are open about zero rates of taxation, but as a consequence have limited bilateral tax treaties. Modern corporate tax havens have non-zero headline rates of taxation and high levels of OECD compliance, and thus have large networks of bilateral tax treaties. However, their base erosion and profit-shifting tools enable corporates to achieve effective tax rates closer to zero, not just in the haven but in all countries with which the haven has tax treaties, putting them on tax haven lists. According to modern studies, the section top 10 tax havens include corporate-focused havens like the Netherlands, Singapore, Ireland and the UK, while Luxembourg, Hong Kong, the Caribbean and Switzerland feature as both major traditional tax havens and major corporate tax havens. Corporate tax havens often serve as conduits to traditional tax havens. Use of tax havens results in a loss of tax revenues to countries which are not tax havens. Estimates of the section financial scale of taxes avoided vary, but the most credible have a range of $100 minus $250 billion per annum. In addition, capital held in tax havens can permanently leave the tax base. Estimates of capital held in tax havens also vary. The most credible estimates are between $7 minus $10 trillion. The harm of traditional and corporate tax havens has been particularly noted in developing nations, where the tax revenues are needed to build infrastructure. Over 15% of countries are sometimes labeled tax havens. Tax havens are mostly successful and well-governed economies, and being a haven has brought prosperity. The top 10 to 15 GDP per capita countries, excluding oil and gas exporters, are tax havens. Because of section-inflated GDP per capita, havens are prone to over-leverage. This can lead to severe credit cycles and/or property banking crises when international capital flows are repriced. Ireland's Celtic Tiger, and the subsequent financial crisis in 2009-13, is an example. Jersey is another. Research shows section U.S. as the largest beneficiary, and use of tax havens by U.S. corporates maximized long-term U.S. exchequer receipts. Historical focus on combating tax havens. There is no established consensus regarding a specific definition for what constitutes a tax haven. This is the conclusion from non-governmental organizations, such as the Tax Justice Network in 2018. From the 2008 investigation by the U.S. Government Accountability Office. From the 2015 investigation by the U.S. Congressional Research Service. From the 2017 investigation by the European Parliament. And from leading academic researchers of tax havens. The issue, however, is material, as being labeled a tax haven has consequences for a country seeking to develop and trade under bilateral tax treaties. When Ireland was blacklisted by G20 member Brazil in 2016, bilateral trade declined. It is even more onerous for corporate tax havens, whose foreign multinationals rely on the haven's extensive network of bilateral tax treaties, through which the foreign multinationals execute BEPS transactions, rerouting global untaxed income to the haven. One of the first section important papers on tax havens was the 1994 Hines Rice paper by James R. Hines Jr. It is the most cited paper on tax haven research, even in late 2017. And Hines is the most cited author on tax haven research, as well as offering insights into tax havens. It took the view that the diversity of countries that become tax havens was so great that detailed definitions were inappropriate. Hines merely noted that tax havens were a group of countries with unusually low tax rates. Hines reaffirmed this approach in a 2009 paper with Dhammika Dharmapala. In December 2008, Dharmapala wrote that the OECD process had removed much of the need to include bank secrecy in any definition of a tax haven and that it was now, first and foremost, low or zero corporate tax rates. And this has become the general financial dictionary definition of a tax haven. Hines refined his definition in 2016 to incorporate research on section incentives for tax havens on governance, which is broadly accepted in the academic lexicon. Tax havens are typically small, well-governed states that impose low or zero tax rates on foreign investors. In April 1998, the OECD produced a definition of a tax haven as meeting 3 of 4 criteria. It was produced as part of their harmful tax competition, an emerging global issue initiative. By 2000, when the OECD published their first list of tax havens, it